In September of 1958, a bank mailed 60,000 fully active credit cards with no application, no credit check, and no approval process of any kind directly into people's mailboxes in one American city. Strangers, teenagers, people who had never once asked for credit in their lives. All of them opened their mail one day and found a working line of credit for the equivalent of several $1,000s sitting in an envelope. The bank called it the drop. Within a year, fraud and unpaid debt had spiraled so far out of control that the executive who invented the idea was forced to resign in disgrace. And yet, somehow, that reckless experiment became the direct ancestor of a card sitting in your wallet right now. Here's why this matters more than it might seem. For most of history, buying something you couldn't immediately pay cash for meant walking into a bank, filling out paperwork, and being personally judged, in person, by a loan officer who decided whether you were trustworthy enough to borrow. The credit card quietly replaced all of that with a small plastic rectangle that just works, almost everywhere, instantly. But that convenience was never inevitable. Banks spent years actively avoiding this idea, viewing consumer credit as beneath them and far too risky to touch. This is the story of how the credit card actually got built, why the industry's own funding legend turns out to be a myth, and why that bank that finally cracked it nearly destroyed itself doing so.